of my former editors used to say that the ideal article or video for Morningstar.com was terribly useful. And when I think of terribly useful content, I think of Mike Piper. Mike is a certified public accountant, or CPA, who writes the wonderful Oblivious Investor blog. He's also the author of several short, terribly useful books on crucial subjects, from Social Security planning to what your spouse needs to know if something happens to you. Mike also developed a free open source Social Security calculator that I often recommend as a useful input. And what Mike does so brilliantly is that he resists the urge to tell you everything he knows. That would be overwhelming. And Mike doesn't feel the need to show off. Instead, he tells you what you need to know to make smarter decisions. I asked Mike about what you need to know about taxes in retirement. Now, at the point that we are filming this particular episode of the book club, it is April the 17th. So we are 2 days past our, tax day. So very topical content. And the person that Christine Benz in her wonderful book, How to Retire, where we're going to cover basically 15 to 20 chapters where she interviews various experts and gets their opinions on subject matter like taxes. Her next interview was with the man Mike Piper. So Mike Piper is going to be the subject of our discussion today, and tax planning prior to retirement, within retirement, and then for after retirement. Those exciting topics are going to be what we cover. Now, I will try to keep this brief, but we are going to nerd out a little bit on some things that are near and dear to my heart, which might give you a little bit of an indication as to what I am interested in life. But let's just jump right in. So they really begin the discussion with the basics of tax management in retirement. And the point that I took away from that part of the discussion was you cannot go into your retirement with absolutely no plan to optimize how you're going to withdraw from your assets in an effort to mitigate taxes, not just in any given year, but actually over the life of the assets themselves. And so for people who have IRAs or who are going to leave an estate, this would include the tax nature of those assets as they pass through the estate, and how the heirs or how your children in many cases are going to be taxed on IRA distributions or non-qualified annuities, things of that variety. So the quote that I pulled that I thought was really salient was this. Mike says, "The goal is not, let's minimize our taxes this year and do that every single year, though that does sound good. If you do that, it's going to backfire, because eventually you're going to end up with a big tax bill later, at least in a lot of cases, once required minimum distributions kick in. It makes much more sense to do a lifetime plan." And I think that is a particularly good piece of advice, especially now, because the rules regarding inherited IRAs have changed fairly dramatically. And Scott and I covered this on a previous episode of the podcast. I'm not exactly clear on which one, where we kind of go through all the ins and outs of who the beneficiary of an inherited IRA can be and what the rules are regarding the distributions that they're going to need to take. And so he goes on to say, but the planning that you do now considers the rest of your life, as well as taxes that your heirs would be likely to pay on any traditional IRA or other tax-deferred accounts they end up inheriting. And the note that I made to myself there is this is now even more important because of the new 10-year rule. And so as he progresses through this book, he talks about some of the various things that you can do that would be part of a lifetime plan. And so he's going to touch on how to use, Roth IRAs and Roth 401ks to your advantage, how we ought to treat taxable accounts, how we can manage with our tax deferred accounts, and in order to coordinate those to best optimize for taxation over the lifetime plan rather than just on a year-to-year basis. And then I'll also provide a little bit of pushback in some areas where I think we might be over-indexing on how much knowledge we can possibly have about the future and where tax rates might go. But we're going to get into next some of the retirement savings vehicles so that we can kind of touch briefly, just as a reminder, on what Mike Piper thinks about these. So your basic retirement savings vehicles are going to be the 401k, your IRA, and then your taxable brokerage account, and then also your Roth equivalents of those. And I'm not going to spend too much time refreshing the memory of the listener on these. Scott and I have covered these ad nauseum on other episodes, and then we just did an episode recently with some planning mistakes that people can make kind of early in their life, so 20s and 30s, and we really touch on how you should go about saving your money for retirement when you actually have that money. But Mike Piper draws our attention to the fact that when you're starting your retirement savings, there are some things that you absolutely want to make sure that you do. And Scott and I share this opinion with him, which is if you have access to a company-provided plan and they provide you a match, you want to make sure that you add enough to that account or add enough to that plan in order to get the match. It's the only guaranteed way to essentially get 100% return on the money that you put into an investment vehicle. Now, that's separate from the performance of the actual asset that you buy. But if you don't put enough money into this plan to get the employer match, you're leaving a heck of a lot of money on the table. Mike Piper says this is absolutely an essential element of being prepared for retirement. The next thing that he dives into, though, and I really appreciated him for doing so, is actually leveraging the HSA. Now, the HSA is not even something that Scott and I touched on when we were talking about kind of preparation for retirement or mistakes a person might make, and that itself was a mistake. And I get a sense that the HSA account is treated a little bit like a redheaded stepchild because you're just not really sure exactly what to do with it. And I think that comes from I think people have a fear of putting money into it, thinking that it's very onerous to get money out of it. And that's just not the case. But let me, and I do apologize because we're going to deviate here for a little bit and nerd out on an HSA, but I think it's important. The HSA is unique in that it is the only vehicle, so far as we have at our disposal as we sit here today, where you get an upfront above the line tax deduction. So that's you're actually reducing your adjusted gross income when you make a contribution to an HSA. It's not taxable to you. You get to defer those taxes. So all the interest and dividends and growth that you get on the assets that you can buy within your HSA, those grow totally tax deferred. And then if you need to take a distribution from your HSA for a qualified healthcare expense, no matter how long that money has been in the account, you can do so entirely tax-free. And this is separate and distinct from your contributions to your 401k or Roth 401k, IRA or Roth IRA. Now, you'll recall, traditional 401k and traditional IRA, you get a tax deduction above the line up front. That money does grow tax deferred, but you pay ordinary income taxes when you take a withdrawal later. And you have to leave that money in those accounts until you're age 55 at least, if you're going to take a distribution from your 401k. But for most of these accounts, it's 59 and a half. And if you don't wait that long, you risk paying a penalty. The Roth accounts are slightly different in as much as there is no upfront tax deduction. You put some money into these accounts with after-tax dollars, they grow tax deferred, and then so long as you have met all of the requirements, you can take your growth and your principal out tax-free. Roth IRA has one special provision for people who make contributions. You can remove your contributions totally tax-free. But here's the other really interesting element about the HSA that a lot of people overlook. You do not have to pay for qualified medical expenses in the year that they are incurred. And so on a coming episode, we're going to dive into the ins and outs of the 529. And the 529 does provide some powerful tax savings for people, but one of the keys to the 529 is you have to match distributions with incurred expenses year by year. You cannot take a distribution from a 529 to pay a previous year's qualified educational expense. They don't allow for it. Not so with the HSA. You put money into an HSA, so long as you keep the receipts for all of your qualified healthcare expenses that you incur after the account has been opened, you can actually reimburse yourself later at any time in order to cover those previously incurred expenses. And that's a wonderful asset. The other thing people overlook with their HSA is if you achieve the age of 65, your HSA becomes a somewhat quasi-IRA. In as much as you can take a distribution for any reason from your HSA after age 65, you do pay ordinary income taxes on it, but you no longer have a penalty associated with spending that money on a non-qualified healthcare expense. The other really neat thing that you can do with your HSA dollars is you can pay for your Medicare Part B and D premiums. And this is very important for people who are in retirement because those income-related adjustments that you might get, the IRMA is what it's called, if those do, for whatever reason, go over the cliff and you have some money in your HSA, you can pay those premiums out of your HSA, and those distributions are still considered totally tax-free. Now, there are a couple of caveats, and there's some things that you can't do, and then I promise we're going to get back to the content after our brief visit here to the HSA land. You can't pay your medical premiums from an employer-provided plan out of your HSA. You cannot do that. If you get healthcare out in the marketplace, so under ACA, you cannot pay your premiums on that health coverage either, unless you meet some other specific provisions, like an unemployment provision or something like that. So there are certain ways that you could do that, but if you do not meet a specific provision, they won't allow for it. And then finally, HSAs are not good in the estate. And here's the reason why. If you pass away, your spouse can inherit the HSA and treat it as her own. That's great. However, if your spouse were to pass away and leave the HSA to, say, your children and to another human being, they have to recognize as taxable income 100% of the account in the year that they inherit that money. It's just a 100% distribution. There's no 10-year rule. There's no lifetime stretch. There's no deferral at all. It's just all recognized right up front. So what does that tell you? It tells you that in your retirement, if you have an opportunity to use your HSA on things that are retirement specific or reimburse yourself for other expenses incurred along the way, make sure that you do so, because this is not a good thing to pass on to your children. And finally, one other thing that you can use your HSA for, which was so cool and we didn't even talk about it on the episode with Mo, is based on your age, you can actually pay a portion of your long-term care premiums on certain policies tax-free with money withdrawn from the HSA. So if we can get back to Mike Piper after that long deviation there, he inserts in this financial order of operations. That's something you've probably heard from, Dave Ramsey has an order of operations. The money guys have an order of operations, and those are all great. This is honestly the first time I've ever seen the HSA being coordinated into that. And it might be because these have only been around since 2004, and you're only eligible to make contributions to them if you have a high deductible health plan. And by the way, once you are on Medicare, so once you're age 65, if you're on Medicare as your primary coverage, you can no longer make a contribution to an HSA. But what I really appreciated from Mike Piper was he's recognized the real value here. And I think that a lot of people are sort of coming to the same conclusion, where maybe this account, long overlooked, generally unfunded by people, even though sometimes, like, we're lucky enough here that our employer provides an employer contribution to our HSA on our behalf. People ignore this account, and Mike Piper is saying you absolutely should not. Look in, see if you qualify, see if you can open one up, start putting some money in it. And his point was use them for healthcare expenses as you go along, because they don't necessarily make great retirement vehicles, but just know there are some real advantages to having some money in the HSA. All right. So we've met our employer match in our 401k. We've taken a look at our HSA. Mike, along with some of the other guys, they really like looking into the Roth IRA as your next available source of adding some money to when you're talking about retirement savings. And so the real key here is a lot of people worry that they make too much money to make a traditional, to make just a Roth contribution. But those phase-out ranges are pretty robust. So if you are a married couple filing jointly, you can make up to $236,000 a year in adjusted gross income before you are being phased out of making a Roth contribution. And that's a pretty healthy income. And so our argument would be, when it is available for you to use that Roth contribution, make it, because like we talked about in the previous episode, you can withdraw those contributions tax and penalty free if for whatever reason you needed to do that. And as we discussed in that episode, that's largely obviated if you have a healthy emergency fund. The other thing, too, is if you cannot make a Roth contribution, you also cannot make a traditional IRA contribution that is deductible. And this is where it can get a little bit confusing. A lot of people don't realize there's another phase-out range associated with traditional IRAs. And a lot of people have heard that the real benefit of the traditional IRA is you can put $7,000 in it, and that will give you an above-the-line tax deduction. That's true under certain circumstances, and I want to get into those here because they're somewhat specific. If you are covered by an employer-provided retirement plan, then they phase you out of being able to make a traditional IRA contribution that is deductible they begin this at $126,000 a year in adjusted gross income, which you'll note is actually much, much less than when they start to phase you out of making a Roth IRA contribution. Okay? Now, if your spouse is covered by an employer-provided plan and you are not covered and you are trying to make your deductible IRA contribution, the phase-out range is the same as the Roth contribution. So $236,000 a year to $246,000 a year if you are married filing jointly. Why do I tell you this? You might be like, Greg, wow, you are passionate about non-deductible IRA contributions. Here's why. The code allows you to convert money from a traditional IRA to a Roth IRA. And where this would be extremely valuable was if you are a married couple and you're at the stage of your life where you guys are making an adjusted gross income more than $246,000 a year. You're doing very well financially, and you're talking about optimization at this point in time. You should be making a non-deductible traditional IRA contribution for you and your spouse every year, and then converting that to Roth. And the reason is there's no provision in the code that disallows this. They sometimes talk about these. You shouldn't be using your IRAs as a conduit. Work with your accountant or financial planner so that you don't run afoul of those rules. But there is no limit on your ability to convert traditional IRA dollars to Roth IRA dollars. And here's why this would be especially pertinent for people who are in this phase of their life. Non-deductible IRA contributions grow tax deferred, and your contribution is considered tax paid basis. And that's important because when you get to retirement and you start to take distributions, you might be under the misguided illusion that you're going to be able to reach into your IRA, grab your tax paid basis, and pull that out tax free, either to spend it or, a lot of people make this mistake, to convert just the tax paid basis to your Roth. This is something we have to counsel clients on all the time. The IRS does not allow you to do that. What they say is, no, this is like when you put cream in your coffee. It's all mixed together, and there's no way you can now reach into your coffee cup and just pull out the cream. But what you will do is you'll likely, with every sip of coffee, be having a proportion of coffee and a proportion of cream. And that's how they treat your tax paid basis. They're saying if your basis represents 10% of your IRA value, then every distribution you take from your IRA, which would include Roth conversions, would only be tax-free to 10%. So say you wanted to do a $10,000 conversion, well, only $1,000 of that would come out of the IRA tax-free, and $9,000 of it would be totally taxable to you as ordinary income. I know that this was a long deviation on some of these topics, but I find this incredibly important because these are the little nuggets that if you were just to execute on this strategy every single year, once you achieve this state of financial success, the amount of money you would have in a Roth when you actually hit retirement based on when in your life you achieve that level of financial success could be dramatically different than if you overlook this provision. And as Scott really likes to talk about, and as we talked about on previous episodes, it will provide you a lot of tax optionality and flexibility when retirement inevitably comes. So you'll have money in a traditional account and a Roth account, and that just gives you a wonderful opportunity to do a little bit more tax planning, exert a little bit more tax control at that stage than if you only had money in tax-deferred accounts. Okay, so Mike Piper likes the robust emergency fund, followed by getting the employer match, followed by using one of these, followed by using your HSA, using an IRA strategy. And then he talks about the real benefits of having money in your taxable brokerage account. Now, if you're a consistent listener of this podcast, you might be getting a little bit tired of us referencing the Scott Bartosh School of Hard Knocks. But as we covered in our previous episode, when we're working with clients who are entering retirement, who have some robust savings and just a standard brokerage account, they tend to have slightly better outcomes in the early stages of retirement and slightly more optionality in the early phase of retirement because they don't immediately have to rely on taking some money out of their IRA and paying ordinary income taxes on it. They can continue to defer that down the road, accumulating money tax-free essentially. By what I mean by that is interest and dividends are not incurring tax drag year over year within their IRA, and then only having to pay income taxes when they take a distribution later. So money in a taxable brokerage account, Scott's very passionate about that. I've become very passionate about it. I think it's extremely beneficial, especially when you enter retirement because it gives you options. It allows you to maybe retire a little earlier, pre-59 and a half if you felt inclined. It's just a wonderful asset to have if you can swing it financially. And we want to be sensitive to the fact that maybe you're not quite there yet in your career, but when you do get there and you have some extra money, don't be afraid of just putting it into a taxable brokerage account because the vehicles have come a long way since a lot of the personal finance books were first published, and you can get some very tax-efficient stuff in place that's not going to incur a lot of tax drag as you further accumulate money in these accounts. So those are sort of the three retirement savings vehicles he talks about. I know the HSA is a quasi-fourth one. but he does regard the taxable brokerage account as a portion of retirement savings. The next kind of subtext or subheading they get into is called their pre-retirement planning. And the quote that I highlighted here was from Mike, where he says, as pre-retirement planning or as you're approaching retirement, Mike says, in general, max out your retirement accounts if you can. And I think that this is a joke that Scott and I have made on this podcast before, where if you broke into a financial advisor's house and shook him awake and said, should I max out my 401k? The first thing we say would be, get the hell out of my house. But after we calm down, we would say, yeah, that strikes me as a generally good plan. But I think, as we discussed previously, you can over-index on these vehicles. And I think some kind of thoughtful authors, and Mike included, and Nick Majuli has been really good on this, who has that blog of Dollars and Data. He's really walked some of that back, where he said, well, we really don't want younger people in their 20s and 30s and 40s to dry up all of their liquidity. And by that, I mean money that they can get access to actually do the things in their life that they want to do. This would be planning for weddings or buying engagement rings or down payments on houses or buying a car. These things come up and they require somewhat lumpy sums of money. And if all of your liquidity is tied up in your 401k and you're in your 30s and you're ready to buy a home or even just go on a really nice vacation, you might suddenly find yourself without the flexibility to do that because you haven't saved enough money in a taxable brokerage account or in an environment where you can actually get your hands on it. The other element of that is, and I think that this is something Mike would point out, there is a behavioral aspect of having money in your 401k plan because you are much less likely to tinker with it than you are if you're trying to save for retirement just purely in a taxable brokerage account. So I think what Scott and I would counsel a younger client on there is you want to make sure that you strike the right balance where you're getting liquidity, you're balancing that against tax deferral and the behavioral elements included in those two accounts. But over-indexing on 401k plans has become kind of a problem. Yes, certainly a nice problem to have. But I would second Mike by saying, in general, yes, if you're wanting to be prepared for your retirement, you should be trying to max out your accounts. They go on and they talk about when you enter retirement, you go through, you're going to have it's an inflection point. And I think for this discussion here, they're assuming that you have access to all of your various accounts now, free from penalty. So if we were talking about a case study of a retiree in the subheading where Mike and Christine talk about sequence of withdrawals, which is separate from sequence risk, which is something that we've gone over, what they're really discussing here is, okay, say I'm 60 years old, I've retired. I have access to my IRA, I have access to my Roth IRA, I have access to my taxable brokerage account. What should I do? Where should I get the money in order to pay for my living expenses so that I don't inadvertently cause myself some major tax headaches this year or when mandatory distributions kick in either 13 or 15 years later, depending on when you were born. So born before 1960, mandatory distribution is going to start at age 73. Born 1960 or later, you actually get to defer that until age 75. And I actually made kind of a note here where Mike is a little bit vague. And my comment to myself at the end of his last paragraph here was, well, that was clear as mud. But I think that he's intentionally vague because there's no real way for us to know how the tax code is going to evolve over time. And so the point that he raises in this case is the traditional advice for a long time has been access all of your tax paid money, so that taxable brokerage account we've talked about, first. And the reason that you do that is because you allow the money that you have stored away in your IRA and your Roth IRAs to continue to compound and grow totally free from tax drag. And that was very good advice for a long time because if ultimately you got to mandatory distributions, and even if they were quite large, the IRA was such a valuable asset in the estate under the previous tax code because your heirs could distribute the sum of that account over their life expectancy, which made it a great asset because the tax hit for them was so minimal every year that it was largely taxed more harshly in the first generation than the second. That's been flipped on its head. And so what Mike tries to get into here now is it's more complicated. it's really difficult to decide, particularly with what I've called the IRA slingshot now, where you have a 10-year period over which to distribute, even if it's a very large IRA, you're going to be taxed way more harshly in the second generation than the first. How to coordinate present day pain, which nobody likes paying taxes, with some, which is certain, rather than a future sort of more abstract payoff that might actually accrue to your heirs if you yourself decide to either convert some of your traditional IRA to Roth every year or just start to coordinate distributions from your IRA as part of your income stream. But Mike says the first tax dollars, or the first dollars that you're going to spend, anything that's just laying around in a checking or savings or non-interest bearing account, that is clearly, I mean, I don't think it goes, I feel like he probably could have gone without saying that. That's the money you ought to be spending first, because there's no future return associated with it. There's no real tax benefit to leaving it where it is. Spend the money in your checking and savings account first, and this would be separate from your emergency fund, so to speak. So he advocates still keeping that in place. The next thing he advocates people do is that if you do have interest-bearing or dividend-paying assets in taxable brokerage accounts, to make sure that those interest payments and dividend payments are set to cash, and that you're just taking those cash flows off of those assets and spending them. Because his point is you're paying taxes on that money whether you reinvest it or spend it, so you may as well just spend it because you're incurring a tax drag every single year, so you might as well get the benefit of having a little bit of additional spending money. And I think that it could be a little bit more nuanced than that, because there might be some assets that you're holding for generational planning, in which case reinvesting the dividend might be a good idea because you might be getting slightly better performance over time. But I would generally agree with that. If you've got dividend-paying stocks in a taxable brokerage account, set those to cash and use it as part of your income stream in your retirement. Mike is very firm, and Scott and I second this too, about putting the Roth at the very end of the line. And the reason that we advocate for people to do that is that all of the benefit in the Roth is in the growth. So you've paid taxes on your basis in the Roth. There's no point in taking a distribution from your Roth very shortly after you funded it, primarily because there's that 5-year rule provision that you've got to meet before you can take qualified distributions from your Roth. But secondarily, and I think more importantly, all of the benefit is just in how much growth you accrued after you paid those initial taxes. And that's the only portion of the account that's really coming to you tax-free. So Mike seconds us. He says, put the Roth at the end of the line. Where this gets tricky, and this is something that we contend with on a day-to-day basis in our practice, is how do we balance the tax saving power or the tax deferral power of the traditional IRA against the specter of a very large future mandatory distribution? And there's a couple of ways that you can do that. So Mike's advice, and I think that Scott and I are kind of warming to this idea over time, and we've been somewhat contrarian on the Roth conversion, and I'll get into that here in a second, but let's primarily talk about money that you need to spend. Every single year, your tax brackets essentially reset. And when you enter retirement and you have now can exert a high degree of tax control, you're no longer getting a paycheck from your employer, and it is what it is, and higher is generally better, if purely for financial reasons. Now that you can exercise a great deal of tax control, it might strike you as a great idea to just use assets from your taxable brokerage account. Maybe you have some stuff at a loss or what have you, in order to really drive down your effective tax rate right after you've retired. That strikes me as like a really why would you not want to do that? Why would you not want to have a few years where maybe your effective tax rate is like 10 to 12 or 15%? That strikes me as an extremely approachable idea. However, Mike's going to caution. He's going to say, well, you have these brackets, and you have the lowest bracket is like obviously the 0, but or the 10% bracket that applies to virtually very few people are going to have money in the 10% bracket. But the next brackets are the 12, the 22, and the 24. And that's really the sweet spot of planning, because that strikes us as a fairly low hurdle. You know, it doesn't strike us as overly expensive to withdraw money from an IRA and pay out 12, 22, or 24% in tax. Ideally, we wouldn't have to pay that much out, but that strikes us as fairly accommodating. Now, the big jump happens from 24 to 32, and that's kind of the cliff that we don't want to go over. And so Mike's point is, say you need $100,000 a year or $150,000 a year on which to live in your retirement. You could theoretically try to get that all from capital gain income. So this would be selling your assets at a gain. And that 0% bracket would actually apply to the first roughly $97,000 of capital gains realized. And then only the back half of that money, so another $50,000 or $60,000 of income, would be taxed at the 15%. and your effective tax rate might be something like 8. That sounds really, really great. However, his thoughts on the matter were, well, you have the opportunity to take ordinary income up to about $207,000 at a very low rate as well. So it might make sense to go ahead and start filling in some of these brackets. That's a term that you've probably heard many times, is bracket filling, and utilize the full extent of the 22% and 24% bracket while you can exert the control today, so that when you concede control, or cede control, I should say, when mandatory distributions kick in, that it's not all of a sudden you hit this, what he calls a tax cliff, where you've been paying very, very minimal taxes over time, but then first year mandatory distribution, you're in the 32 to 35% bracket. And if you live a long time, you might actually be in those high brackets until you pass away. And even when you pass away, what he points out happens is your spouse now files as single. And so those brackets compress dramatically by half. So she might actually, or he might actually get pushed up into the 37% bracket. So he really advocates for essentially blending your income, and doing so by working with a professional year over year, figuring out, here's how much dividend income I'm going to have this year. How much should we take out of our IRA in order to live on, so that we can kind of fill up these lower brackets? That strikes me as a wonderful bit of tax advice, or tax planning, I should say. The other half of it, where it gets a little bit more complicated, is, say you can live on stuff and you're still well within that 24% bracket. So you're maybe just pushing up against the 22, but you still have $20,000, $30,000, $40,000 you could withdraw from an IRA, and it wouldn't push you out over that 24% bracket. You're not yet 65, so you don't really need to worry about your IRMA or your Social Security benefits just yet. That's when you have this dilemma. Do you go ahead and convert that amount to a Roth? Or do you just let it continue to compound in the traditional IRA and kind of worry about the tax hit later? And I think this is really where, depending on who you're working with, you could be of two minds. Some people would say, you have been given a gift from Congress of that 24% bracket, and it could go away. You know, there was questions as to whether or not the sunset of the current code will happen. We're still waiting to see what the tax bill is going to be coming out of the Trump administration, and whether or not we're going to have the exact same brackets. But if they were to revert to the 2016 brackets, that 24% bracket does go away, and you get your 25 back, and it's slightly more onerous at those middle income or those middle ranges. And that's the point Piper makes here. Is he's saying, as long as you've got that 24%, use it. And if you're going to spend the money, great. But if you can convert it to a Roth, and some people, they think even better. Now, Scott and I like to embed that in a very specific context. And that context is this. For most of the people we work with, and this isn't necessarily true for everybody, but once a dollar has been put into the Roth IRA, you're not spending it. Your kids are going to spend it. And the reason for that is they tend to, despite doing ongoing Roth conversions, have so much money in their tax deferred accounts that it never makes sense for them to take a distribution from the Roth. And then once RMDs kick in, they really don't need to take additional distributions from the Roth. I'm not saying that there is never a case where you might take a distribution from a Roth. And one of the points Piper raises is to say, well, let's say you are one of those unlucky people who has major medical expenses at the end of your life. Roth distribution can be very helpful, because now you can get some money out of your retirement accounts without paying any additional taxes. And I thought that was a really great point. And then the point Mo made on the episode that we did with him regarding long-term care, you can also take a distribution from your Roth in order to do essentially a single premium policy payment. And that was something that Mo had advocated for. So we've been contrarian on the Roth largely because it's essentially paying taxes for the benefit of your own children. And for some people, that's really important. They want them to inherit some assets that are going to be extremely efficient within the estate. And if that's a goal of yours, then I would certainly be an advocate for filling up your tax brackets up to that 24. I think beyond that, it just becomes too expensive of a proposition. It requires that you pay too much out in taxes too soon as a retiree. And remember, a dollar paid out in taxes is not a dollar that you're getting back. That leaves the plan forever, and it does not come back. So when Mike talks about the sequence of withdrawals, it's somewhat clear, but I think, and this was a note that I made to myself, it's going to be kind of a delicate balance between how much pain you're willing to take in the current year, how much taxes you're willing to pay today, versus how much of a future benefit you might get for having done so. And that's only something that you can decide, you working closely with your tax preparer or your advisor. And that's certainly a conversation that I would advocate everybody have. So we go through the Roth conversions. He's kind of a fan of that. And then we get into the phase of your retirement where required minimum distributions become the reality. And so if you can imagine us moving along this spectrum, you retire at 60. You have this period of time between 60 and when you file for Social Security. You can exert a very high degree of tax control. During that time, he advocates for blended income stream, taxable brokerage account, traditional IRA, and maybe mixing in some Roth conversion. And now we are still deferring all that money in the Roth. So he has not advocated that we take any money out of the Roth. So required minimum distributions. This is the thing that for virtually every retiree kicks in at age 73 or 75. We touched on that briefly. Now, I'm not going to bore you with all the intricacies of the RMD, how that is calculated. It's a very simple, very basic kind of life expectancy calculator and value of your assets in your IRA at the end of the year, a little bit of division, and they spit out your required minimum distribution. There are some provisions you can defer your first mandatory until April of the following year. That generally doesn't make sense unless you're in a very unusual circumstance, because then you would have to essentially manage 2 RMDs in that 1 year. But the part of this discussion that I really want to dig into is the Qualified Charitable Distribution, or a QCD. So Mike made a really good point in their discussion about QCDs that I wanted to reiterate here. But before we get to that, I just want to bring everybody up to speed on when those become available and how they're generally used. So Congress, in their infinite wisdom, they moved the RMD age from 70 and a half. And the joke that I make is that Congress and my children share a few things in common, but one of which is they celebrate half birthdays. They're very serious about that. And then they moved it from 70 and a half, the RMD age, to, for a while there, 72. And then they said, never mind, it's actually going to be 73. And for some people, 75. So very clear on exactly when it is RMDs are going to kick in. But the good old qualified charitable distribution, they left hanging back at 70 and a half, which for a lot of people has created this sort of awkward phase where they're 70 and a half, they have money in a qualified account, so an IRA, or again, you cannot do QCDs from a 401k. You can only do these from an IRA. They have some money in IRA. They haven't started taking distributions yet because they haven't needed to. And they might come to us and say, well, should I be doing QCDs now, or should I wait until I'm actually RMD age? And my response has almost invariably been, start making QCDs as soon as it is available to you. And the reason being is this is the only legal tax-free way that you can shrink the size of your IRA. And we know that these are no longer very good vehicles in the estate. We know that RMDs are escalating. We know that RMDs will be more of a tax burden for the surviving spouse when and if they are, in a position to just be a single filer. And so the qualified charitable distribution allows you to start shrinking the size of your IRA while achieving one of your philanthropic goals. Now, what I counsel clients on is don't become charitable just for the tax benefits. I don't think that's generally a good strategy. If you're not charitable now, you're probably not going to be. But as soon as these become available at age 70 and a half, you should be talking to your advisor about moving your charitable giving to qualified charitable distributions. And the point that Mike made is it's kind of like a Roth in this respect, in as much as you've actually gotten a tax deduction in some cases to put this money into your traditional IRA. It has grown tax-free, and now this is the only time that you can distribute this money also tax-free in an effort to satisfy one of your goals. So his point and my point has generally been, why would you not use this? So I think you should use them early, you should use them often, but let's move along the time span to where we're actually required minimum distribution age. So now you're 73. You have your first RMD. QCDs are even more powerful, and here's why. They finally indexed this number up, so in 2025, you can take as much as $108,000 out of your IRA tax-free in a qualified charitable distribution. And now, just for some mechanics here, this has to go directly from your IRA. The check must be made out to the charity. You cannot take a distribution from the IRA and then write a check to the charity. It doesn't work that way. It's got to go directly from the IRA to the charity. 2025, you can take $108,000 out. These qualified charitable distributions count toward your RMD. What that means is you can take a portion of the amount of money, or all of it if your RMD is small enough, and do it tax-free. The government allows for that. So unlike Roth conversions, when you are of RMD age, if you convert some money from your traditional IRA to your Roth, that does not count towards your RMD. but a qualified charitable distribution does. So that is a distinction. That is a reality that is such a benefit to the retiree who has large RMDs. And often they have not even realized that they were eligible to do these things. And their only wish is, wow, I don't know why we didn't start doing these things earlier. Because QCDs, they don't hit your adjusted gross income. So if you want to keep your provisional income low for Social Security purposes or for your IRMA purposes for your premium payments on Medicare Part B and D, this does not hit your adjusted gross income. If you are itemizing your deductions, and say this would be a little bit more difficult now because they've just limited this so much, but this doesn't prevent you from itemizing. So if you have a large mortgage, if you're paying out a good bit in real estate taxes, or if you qualify for some of the other deductions, they're much more difficult to qualify for now. This doesn't prevent you from itemizing, and it doesn't prevent you from utilizing the full standard deduction. So you can do a qualified charitable distribution and still claim the full standard deduction on your return. So QCDs have a ton of benefits baked in. And the other thing too is they spare the other assets that exist outside of your IRA and allow those to pass in the estate as opposed to IRA assets. So you can preserve assets outside of your IRA for growth, assets that in many states will benefit from a full step up in cost basis. And that will be a far better vehicle to pass to your children, these assets outside of the IRA, than inside of the IRA. So our advice is lean heavily into qualified charitable distributions if you are charitably inclined, and especially when or if you have large RMDs. Mike is a huge proponent of that for all of the tax benefits. Then they covered a little bit on, kind of out of order, I would say, in this chapter, a little bit on Social Security and how those things are taxed. And there is one point of clarification I want to make for people who are confused about how this works. And I'll point out where they're confused. Social Security works on a provisional income basis, and the thresholds for having Social Security be includable in your taxable income are really low. So if you are a married couple, up to 50% of your Social Security benefit is going to be taxable at just $32,000 of provisional income. That does not mean your Social Security benefit is taxed at 50%. It just means they're going to include half of your benefit as taxable income, and it's taxed at your ordinary income tax rate. Okay? The next threshold is if you're a married couple and you have more than $44,000 in provisional income, 85% of your Social Security benefit is included in your taxable income. Not taxed at 85%, it's just included in your taxable income, taxed as all other ordinary income would be. Now, Mike's point, my point, I think the point that most advisors would make is if you have means in retirement, whereas if Social Security doesn't represent a huge portion of your retirement budget, and I can appreciate that for some people it will, it's very unlikely that you're going to be able to escape taxation on your Social Security benefits. So what Mike likes to do, rather than trying to worry about whether or not those things are going to be taxable, is he would prefer you work closely with your advisor and talk about, based on my planning, on my longevity assumptions, on what my spouse might need when I pass away, how can we coordinate our benefits in order to maximize them over our retirement period? And that's really what everybody should be doing for you. There's a lot of tools out there. Virtually every advisor will understand how this works. Maximizing Social Security benefits is not just as simple as deferring until 70. I think we've over-indexed on that. A lot of people like to think that it is. It's not. And Mike actually raises some interesting points in this chapter as to how that might not be the case for everybody. But there's just not a lot a person can do once they're retired in order to avoid having their Social Security be includable in their taxable income. The next little bit they talk about here is the income-related Medicare adjusted amount. That's that IRMA premium that we've been talking about. And how this differs from some of the other parts of the tax code is there's no gentle phase outs with IRMA. It's if you get 1 penny more in taxable income than you did previously, your premium payment might jump by, $100 a month, something crazy like that. So it can be very expensive to inadvertently take a little bit more taxable income in a given year. And that becomes particularly pressing when you're investigating doing something like a Roth conversion. So just be cautious there. If you're bumping up against one of those income-related Medicare adjustment thresholds, talk with your advisor, make sure that what you're doing is ultimately going to prove to be more beneficial than the additional cost you're going to have for your IRMA benefits. And then one thing that I think everybody should know, especially if you are retiring, right near when you're going to claim Medicare, okay? So IRMA has a 2-year look back. So your adjusted gross income 2 years ago is what dictates what your premium payments are going to be in this tax year. And so there are some cases where you can apply for relief. That's what it's called. So let's imagine that you are working and you are 63 years old and you're at the peak of your career. You're right about to retire. You have a very high income year when you're 63. And now you're going to file for Medicare coverage at age 65. Now you can imagine what kind of unusual situation this might create is your income has very likely dropped off dramatically since you've retired. So at age 64 for that tax year, you probably didn't have nearly as much taxable income as you did when you were 63 and still working. But they're going to assign you a premium payment for your Medicare Part B and Part D based on your income when you were still working because you retired so close to when you were going to file for Medicare. One thing that you can do is you can essentially apply for relief based on a significant life change. And this would include things like a death or a disability, but retirement could also be one of them. And just say, hey, could you rather look at last year's income? Because this is far more representative of what it's going to be like for me in retirement than what it was 2 years ago. And apparently, according to Mike, they're generally fairly amenable to that. So they'll provide you the relief and they'll assign you that income related Medicare adjusted amount based on last year's income rather than the 2 years previous income. Finally, and I know we've gone a little bit long here, so thank you for bearing with me. We're talking about lifetime giving and bequests, and really the only part here that I'll discuss is this links back really nicely with both the book we covered by Bill Perkins, Die with Zero, and the Happy Money one that we did by Michael, I think it was Elizabeth Norton and Michael Norton. Well, they're not both Norton, but Elizabeth Dunn and Michael Norton, excuse me, where Mike Piper is going to advocate for bequests made while you are still living. So giving with the warm hand as opposed to the cold hand. This allows you to in a very targeted fashion, essentially gift out the assets that you want to gift or shrink your estate if you feel like you might have a taxable estate. And as we discussed with Happy Money and in Die with Zero, it creates an effect on the giver and on the receiver simultaneously, and that there's a synergistic effect there that essentially allows both parties to be made happier because the giver gets to see how the receiver is going to be blessed by that money or how they're going to use the money, and vice versa. The receiver gets to be very gracious to the giver at life and actually thank a living, breathing human being for the monetary sacrifice that they're making on their behalf. And what I called it was the giving dead weight loss when you give through the estate as opposed to at life. And then one of the other things that Mike talks about, and Scott and I've reiterated this a couple of times, is across the time or across the span of your life, getting a big chunk of money is not going to feel the same. And his point was a slightly smaller chunk of money given to a person in, say, their 30s is way more valuable, some multiple valuable, than to that person receiving that money in their 60s. And so now with where life expectancy has gone, a lot of people are inheriting assets from their parents when they're already retired. They themselves are retired. So their parents pass away and they're retired. And in many instances, that's certainly helpful, but they probably look back over their life and think, wow, if they had had the financial flexibility to give me this money when I was getting my family off the ground or when we were buying our first house or any number of things that tends to happen to any number of financial problems that younger people tend to be beset with, I think that Mike identifies that as a very powerful time for giving. So I know we covered a lot there. That was the chapter on Mike Piper, which is a lot about managing your taxes, optimizing your taxes in retirement, a lot of balancing what we know today versus what we think we might know about future tax rates. But yeah, that closes this down.
This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. The broadcast may not be reproduced without express permission of Robert W. Baird & Co., Incorporated.